You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
Welcome back. This is Mining Stock Education, and I am Bill Powers. Thank you for tuning in. If you'd like to engage the show, feel free to reach me at bill@MiningStockEducation.com. On today's show, we are going to be hearing from fund manager Matt Geiger of MJG Capital. Website is mjgcapital.com. And Matt put out in the last couple weeks his recap of his 2019 performance for the fund. And I'm happy to tell you, the listener, that Matt was successful. Almost 76% gain on the one-year performance. And Matt, relative to most fund managers in this sector, is quite young, but he's been at this 8.5 years. So I really admire him for his entrepreneurial ambition in starting the fund and also for the insights that he offers. So Matt, welcome back onto the show. I appreciate you joining me. And what are your personal thoughts about your performance last year, and how do you think you're going to manage the fund in 2020?
Well, thanks for having me back on the show, Bill. Indeed, 2019 was a very strong year for us. As you mentioned, we were up roughly 76% over the course of the year. This technically wasn't our best year since inception, at least in absolute terms. That distinction belongs to 2016, where the fund was up 95%. And you can probably remember that euphoric 9 months as we came off the bottom of the 2011 through 2015 bear market with a bang in 2016. However, I was pleased with the relative performance this year, because in 2016, it seemed like almost anything was up if it had to do with the mining space. And the TSXV was up 45% in that year. Whereas just last year in 2019, the TSXV was up a modest 4%. So the gulf and relative performance was much stronger last year. I was pleased to report those results in the most recent investor letter, which, as you mentioned, is available on the fund's website. I would say that another key point here is that the fund has now outperformed both the TSXV and the S&P 500 over 6-month, 1 year, 3 year, and 5 year time horizons. And that's the first time I've been able to report that since inception. So that is positive. I think we have the wind at our back for the first time in a while. This performance in 2019 was largely driven by our gold and silver focused investments. As you know, one name that I've talked about quite a bit publicly is Adriatic Metals. That was another that was a strong component of our performance, and I consider that a silver focused play. It's really polymetallic, and the total revenue from each of the company's metals is pretty spread out evenly, but I classify that as silver focused. Our precious metal exposure now sits at around 50% of our weighted portfolio. And I'm happy with this weighting, but don't want to see it go much higher. And as I note in the letter, I'm going to spend the coming months here fortifying some of our higher quality base and energy metal positions, focused on metals like copper and nickel and uranium, while also hopefully slimming down the portfolio a bit. We're at 25 names, which is within the range of the number of positions that I'd like to have, but I'd rather get it into the 15 to 20 company range if possible. So those will be my goals over the coming few months here before I report mid-year results in July.
Do you expect to have your gold and silver equities outperform in 2020, or are you looking to a different commodity to kind of lead the way in your positions?
Well, at the end of the day, we're bottom-up investors, and so I try not to get too sucked into market predictions. This is a very volatile, very difficult industry. Things change quickly. If I had to guess, I think we'll probably see more of the same this year, where gold and silver investments outperform, while there's headwinds on the base and energy metal space, due to a continually strengthening U.S. dollar, and then economic slowness out of China due to the coronavirus outbreak. That will at least have a quarter or two impact. Certainly don't think that's the end of the world. I have a long-term time horizon as an investor, so that's not affecting any of our investment decisions in any way. But I also feel there is the chance for an upside surprise this year as well with the base and energy metals. Sentiment is extremely negative right now. And there's a chance that stimulus out of China in particular, but also out of emerging markets generally, could push actually the base energies metals higher this year to people's expectations. So hoping for the best, but not expecting it. I think they're great places to be over the next 3 to 5 years. So we're going to hang tight.
We'll be right back after this word from our sponsor. Osino Resources is a Ross Beatty-backed gold exploration company in mining-friendly Namibia. Osino's district-scale land package is situated near 2 producing gold mines, one of which Osino's management team previously developed and sold to B2 Gold. Osino's founders and management are experienced mining professionals who have already successfully developed and sold 2 companies in the past 7 years. Osino has a tight share structure, and with its current treasury, it can self-fund the advancement of its gold discovery into at least 2022. This is an exploration company with drills turning that you'll definitely want to pay attention to. Osino trades in New York under the ticker OSIIF and in Toronto under the ticker OSI. To learn more, go to OsinoResources.com. That's OsinoResources.com. You shared your commentary on what's going on in the gold sector with the royalty companies under market musings in your letter. Can you give us an overview of what were some of the key points that you talked about there, and what kind of investment opportunities does that create for the investors listening to us?
Certainly. So yeah, I think the rise of the royalty business model over the past 10 to 20 years is really the elephant in the room in the mining industry, and something that most operators don't like to talk about, but it really has revolutionized the industry. Investors love this business model for a handful of reasons, and I kind of run through these in the piece in the letter. A few of these are that by buying a single royalty company, you can become incredibly diversified. The Franco-Nevadas of the world have over 100, to my knowledge, cash flowing royalties, as well as a large basket of soon-to-be cash flowing royalties. So you get exposure to multiple jurisdictions, multiple different deposit types, multiple operators, and you can really hedge your bet by just buying 1 or 2 royalty companies. Another reason investors like it is due to the extremely high margins in the business. It's famously said that Franco-Nevada earns roughly $3.5 million. It generates roughly $3.5 million in revenue per employee per year, and this puts the likes of Google or Goldman Sachs to absolute shame. So extremely profitable business. Another is the scalability of the business. As these royalty companies grow, as they accumulate more and more royalties, their cost of capital gets lower, while at the same time they're open to larger and potentially better opportunities within the space. So scalability is not an issue, and even Franco-Nevada, the largest royalty company right now, continues to grow at a pretty rapid clip. Then there's the limited operational risk, which is a huge part of it. As a royalty company, you own a percentage of revenue that's produced from the mine. So any unexpected sustaining capex expenditures, that's entirely on the operator's shoulders. You don't have to put up a cent for that. Any drilling, either exploration or continuing to drill out the resource, you don't have to put up a single cent for that. So that's all on the operator's shoulders, and any hiccups fall unevenly on the operator in these royalty setups. And then, of course, there's the free perpetual option on discoveries, as Pierre Lassonde puts it, which basically means that these royalty companies, they may initially buy a royalty over a mine life, a mine that's supposed to run 10 to 15 years. But in certain cases, especially if the geological setting is right and there's some luck involved, these companies can buy a royalty that ends up paying for 30 or 40 years with a new discovery on the larger land package. So these are quite a few of the reasons why investors love this model. The space has been on absolute fire over the past 18 months. Franco-Nevada, as you know, is kind of the bluest of the blue chips for royalty names. Franco actually entered the 2011 mining bear market and then exited it in 2015 at a higher share price in which it entered, which was incredibly impressive, and I think caught the eyes of a lot of investors. And Franco continues to hit 50 or all-time highs, basically every week. Actually, just today they hit an all-time high as well. The sandstorms and the wheat and precious metals of the world are also up over 50% just since the beginning of last year. And then you're seeing the junior royalty names, the EMXs or the Abitibi royalties, the Metallas, Mavericks, the Ely Golds of the world have more than doubled in some cases over the past 13 or 14 months. So the space has been very, very hot now for 18 months or so, if not longer, if you're looking back in Franco-Nevada's performance. And in terms of opportunities that this offers, there's kind of a couple places I'm looking at. The first is, I think, the disconnect between the precious metal royalty names and the multiples that they get on their cash flow, as well as the NAV multiples. The disconnect between that and the base and energy metal royalty names, like the Altus Minerals or Anglo Pacifics of the world, it's too extreme. I'd say Altius is probably the marquee base metal royalty name out there, and Franco-Nevada has a cash flow multiple that is more than double of Altius's, and I don't think that's sustainable. At the end of the day, cash flow is cash flow, whether it's coming from a copper asset or whether it's coming from a gold asset. And so I think, especially amongst the base and energy metal names, we're going to see multiple expansion in the years ahead, especially as investors start warming to base metals. And additionally, I think there's a wider playing field. There's more royalties available and less competition. So I think in the base metal space, you're probably going to see better deals on offer than in the precious metal space. And then just quickly here, because I am a prospect generator investor as well, and you'll see in the investor letter that roughly 20% of our weighted portfolio is exposed to prospect generators. I think there is an opportunity for a select few companies that have been, quality prospect generators for years now, to transition into kind of a tried and true royalty company, and then get the associated multiples that are attached with that. So there are a couple prospect generators that either have a cash flowing royalty or two, or will soon have a cash flowing royalty or two. And I think over these next 2, 3, 4, 5 years, these companies have the opportunity to add another few producing royalties, either through acquisitions or through continued organic growth, and kind of make the jump from a prospect generator to a royalty name, which I think in some of these cases would be very lucrative for the company's shareholders. So those are the two kind of opportunities I'm looking at: base and energy metal royalties, and opportunities for prospect generators to make the jump to a royalty name.
You touched on the disconnect between the valuation that a gold royalty company receives versus a base metal royalty company. What do you attribute that to? Why the disconnect?
Yeah, I mean, it's a good question. I think there's a certain luster to precious metals, and there's always been. So I don't think there's an obvious explanation to it, other than investors that want precious metal exposure have found that royalty vehicles are a great way to do so with a little added leverage versus just buying the metal directly. And you just haven't seen that in the base and energy metal space yet. So, maybe some premium is warranted for the precious metal names, just due to the unique circumstances and kind of the rabid fan bases that gold and silver has. But I just think the current disparity is too extreme and can't be easily explained.
As you were discussing that, I remember hearing somebody say, "We raise money with gold, but we make money with copper."
Yeah, I think that's a good quote right there. And hell, even Mark Bristow is maybe thinking through that lens as well, as he mulls adding more copper exposure to Barrick. So I do think that as a whole, the industry is a little too focused on precious metals. On the TSXV, I ran some numbers recently, and 45 to 50% of the juniors are focused on either gold or silver. Whereas if you look at the total global mineral production, gold only makes up, we'll say, 15 to 20% of the total value. So it does seem like there's a misallocation of capital there, which could be to the advantage of investors that look beyond the obvious metals.
We'll be right back after this word from our sponsor. Arcana Corporation is on the verge of bringing the world's highest grade silver mine into production. The Revenue Virginius mine in Colorado has proven improbable silver reserves grading nearly 37 ounces per ton silver with an all-in sustaining production cost of only US $8 per ounce of silver. The mine is fully permitted with infrastructure already in place, and the company has announced they plan to commence production in 2020. Achieving successful production usually results in a significant upward share price re-rating on the Lassonde curve. Arcana trades under the ticker AUN in Toronto and AUNFF in New York. To learn more, go to arcana.com. That's AURCANA.com. You also invest in uranium. Uranium equities have been pushed down. What's your thoughts on the uranium equities? Are we seeing a bottom here, and what's your outlook?
Well, I think I think it would be foolish to try to call a bottom at this point. This has been a extremely protracted and painful bear market for uranium equities, really since the Fukushima disaster in Q1 of 2011, and it really hasn't abated since. Things got particularly ugly in late January, and kind of the setup there is that investors were expecting Cameco to make significant spot market purchases in order to fulfill contracts that they have outstanding with utilities, because as you know, Cameco's shut down MacArthur and is limiting production across a lot of their assets, and has decided that for the time being, it's better to satisfy their contracts through spot market purchases than through actual production. And so the market was anticipating a boost in the spot price, in November and December, and it frankly didn't happen. Now, this is Cameco just deferring these purchases. They will occur in 2020. So I think investors with patience, this was an opportunity. But uranium investors were already so under siege and, close to the breaking point that I think not seeing that move by the end of the year shook a lot of weaker hands out. And so January kind of started on a muted note, and share prices of most uranium equities were largely range bound going into the end of the month. However, on January 24th, kind of an unexpected development occurred. The managers of the URA uranium ETF made the last minute decision to boost Kazatomprom, the Kazatomprom exposure to 20% of the overall ETF from effectively zero. And in order to do this, they, of course, had to sell 20% of their assets, including some of the other uranium juniors that they held. And so this created what I'd consider non-fundamental selling pressure, which is always an opportunity. Remember, this selling isn't due to any fundamental reason or any fundamental flaws with the companies that are selling. It's purely due to a reallocation decision towards Kazatomprom. And so if you look at the share prices of names like NextGen Energy or Denison, just look at them on January 24 and then what happened in the 5, 6, 7 trading days afterwards. There was significant selling because the year started on a muted note anyway, and it really hurt and took 25, 30% off of the share prices of some of these companies. And so, I'd view that largely as a perfect storm. Again, I don't know if this is necessarily the bottom here, and I think it'd be foolish to try to predict, but we're getting closer. And anytime I see non-fundamental related selling, that perks my attention a little bit. And so, I'm going to have increased focus on uranium here going forward. And then I'll also note that we do have some clarity from the Trump administration finally on what actions they plan to take in order to boost domestic U.S. production. And you probably saw last week reports came out that in the upcoming budget, Trump plans to allocate $150 million per year for the next 10 years in order to establish a strategic uranium stockpile within the United States. And of course, they'd be buying that from U.S. uranium producers. I have to note, and I think it's important, that this needs to get passed by Congress. And this is a pretty contentious budget as is. I know there's also cuts to Medicaid and healthcare, along with a lot of other services. So it remains to be seen whether this is even passed into law. That said, I think it's helpful to get more clarity here. This has been an extremely painful and drawn out process, first with the Section 232 petition, lasting into July of last year. Then the working group established with recommendations expected within 90 days. Then the working group recommendations delayed into this year. But we finally have some clarity on, what may happen here. I think this is largely positive for non-U.S. based uranium assets, and I think the jury's still out. But if you look at the reaction of the U.S. based uranium names like Energy Fuels or UEC or UR Energy, even in light of this recent news about the budget, their share price reaction has been largely muted. And I think the market potentially baked in more extreme intervention from the Trump administration. I mean, if you run the numbers, $150 million in purchases is about 3% of the global uranium demand on a yearly basis. So it's not insignificant, but it's definitely not a structural shift for the market either. And so I think for shareholders or potential investors in non-U.S. based energy equities, this gives them further confidence that U.S. intervention isn't going to affect the market all too significantly. And then, of course, for uranium investors everywhere, the hope is also that this further clarity will spur utilities to step up and start that next contracting cycle now that there's a bit more clarity of where they should expect to be buying their uranium from. So lot of moving parts here. I'm reluctant to call the bottom. But there's been a few positive developments here, especially for the non-U.S. based uranium names.
Could you talk about, if you can, any of the qualities you'd want to see in a potential uranium investment or speculation that you would potentially add to your portfolio this year? Like, for example, I just saw GoviX did a raise and they offered a full warrant for 5 years. And we haven't been seeing many full warrants in 5 years, especially in the gold space of recent. But what would incentivize you to maybe add a new uranium position to the fund?
It's a good question. I did see that GoviX placement. Definitely attractive terms. I think the way to approach the vast majority of uranium names is to wait for placements. And so, no reason to buy on the open market. It's been an extremely painful period for a lot of these companies, and they need to cash up soon. And so I would wait for the next placement, evaluate the terms, and go from there. I think there are very few names that you should feel comfortable buying on the open market right now. I also feel that it's a really tough time for uranium exploration. There's at least one company out there drilling out what looks to be a new discovery, but especially if you're drilling wildcat holes and trying to make the next big uranium discovery, I think it's going to be very tough to finance in this market environment. There's already a ton of pounds in the ground out there that are sitting at very cheap valuations that need higher uranium prices in order to incentivize those going into production. I think in a lot of cases, it makes more sense for investors to invest in those cheap pound in the grounds than to invest in a grassroots explorer looking for that next big discovery. So, if you're going to buy in the open market, make sure that the company has months, hopefully 12 months, if not longer, of working capital before the next raise, with milestones to come in between. Otherwise, even if there's uranium names that you really like management, you like the opportunity, it's probably a good time to just sit on your hands, wait for that next financing, and then move in aggressively there, hopefully getting a full or half warrant as a sweetener.
Matt, as I was reviewing your allocation by commodity in your fund, you have investments in bauxite, rare earths, vanadiums. You've previously held a graphite position. When it comes to these niche metals that aren't mainstream, can you talk a little bit? What does your due diligence process look like when it comes to these?
I would say, in short, it's actually not very different from what I would do if I was looking at a copper-focused or a gold-focused name. Because at the end of the day, we're bottom-up investors. And so I generally look at the following things in this specific order. First, I'll look at the people involved. Are they honest? Are they ethical? Are they experienced? Have they made money for shareholders before? Are they well incentivized, with skin in the game? Do they run the company lean and put as much money into the ground as possible? That's always the first thing I'll look at, whether it's a gold investment or whether it's a molybdenum investment. Then I'll look at the actual project in question. If it's exploration stage, does this have the potential at least to be a world class or a tier one project, something that could move the needle for a larger player? If it's development stage, does the project make sense at current metal prices? And then I'll move on to the financial structure. Does the company have enough working capital to advance the project and make it through multiple milestones? Is there a bunch of debt sitting on the balance sheet? Is there a warrant overhang? Then I'll look for catalysts. What are the particular drivers over the next 6, 12, or 24 months that could cause a re-rate and a substantial re-rate in the share price? Then I look at price to value. Then I look at jurisdiction. Only then, at the very end, do I consider the actual commodity. And so when I get to that, there's a few things that I'll consider. And again, assuming that it's a niche energy metal play and it checks all the previous boxes, I'll first ask, how does this fit into the current portfolio? Maybe we'll already have significant or somewhat substantial exposure to that metal, in which case that makes it probably less likely for me to be interested, because I like to kind of hedge commodity price risk and don't want too much exposure, especially to a niche metal. However, it's also possible that maybe we have no exposure to that metal at all, and that could pique my interest. I'll ask myself, is this niche metal in the midst of a speculative bubble? Am I buying lithium in 2016, or am I buying cobalt in 2017, or am I buying vanadium in 2018? Am I getting in too late? When you're seeing juniors pivoting into the space, every week, and then every few days you see a new company pop up. If we're in the midst of a speculative bubble, then I'm not a trader. I'm not a momentum trader. That's not my game. So I'd rather steer clear from that metal entirely. And then conversely, has a speculative bubble just popped? I've learned pretty quickly here not to try to catch a falling knife, especially with these niche metals. And after the fun is over of a speculative run up, I'm not the one trying to pick the bottom when it's on its way down. So the best case scenario for me is that the metal really isn't too hot, isn't too cold, and is being largely ignored by fellow investors and then also the financial press. So I kind of like obscurity and apathy if I'm to initiate a position in kind of a new niche metal. But again, at the end of the day, I'm relatively metal agnostic, assuming that I've got the right people, the right project, the right financial structure, et cetera. And I'm happy for exposure to kind of varied metals. And if these boxes are checked, then I'm willing to be an investor.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of high-grade copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion, with a 33% internal rate of return. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades in New York and Toronto under the ticker TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com. Matt, what's your analysis of Ecuador as a mining jurisdiction? You are invested in Salazar Resources in Ecuador. Can you share with listeners your take on Ecuador?
Sure. Well, I mean, Ecuador's, I think, an exciting place at the very least to be looking at right now. There's an incredible amount of untapped mineral potential in the country, given that the same metallogenic belts that run through, Peru and Chile and make both of those countries, global mining heavyweights. They also run through Ecuador. So it has the same geology, but due to a couple factors, it's seen a fraction of the spend that those two countries have. And the two factors are mainly political instability. Ecuador has had 51 presidents to my count over the past century. which is just insane to think about. So that's obviously not a stable environment that your average mining company would want to invest in. And then additionally, they really had a stifling mining code for years, where mineral projects were treated the same and taxed the same as oil and gas. And that's not sustainable for those of us in this industry. We understand the economics are very different between oil and gas projects and mining, and you can't treat them the same and burden mining projects with 10 or 12% royalties. It just doesn't work. But things have really changed over the past 5 to 6 years for Ecuador. So I would argue that the country is on the upswing. In 2014, Ecuador engaged consulting firm Wood Mackenzie to revamp the country's mining code, and just a year later, they actually added a standalone mining industry for the very first time in the country's history, and also reformed what was called the sovereign adjustment tax, which was an onerous tax that was prohibiting development. And then, just last year, President Moreno, who's the pro-mining Ecuadorian president, abolished the windfall tax and lowered the minimum federal royalty rate from 5% to 3%. And then, of course, last year was also capped off with first production from Lundin Gold's Fruta del Norte in November of last year, which I think was a big win for mining companies across the country, because Lundin was able to prove that they could get that mine up and running with minimal issues, both socially and environmentally. So I think they've done a very good job being a steward of mining in Ecuador. But of course, where there's opportunity, there are plenty of risks. Last year, an issue we saw is that there was a rogue minister within the water ministry, and he, in essence, was holding up water use permits for drilling across the country as a way to stop mining carte blanche. He eventually got pulled out in Q3 and replaced. So that bottleneck has largely been resolved, but that caused 2019 to be a stagnant year for most of the juniors and even majors across the country. Another issue we have is that the mining cadastre has been closed for over 12 months now. And so no new concessions have been granted over this period. The good news is that this should change, hopefully by mid-year 2020 or maybe in Q3. And I know there's plenty of companies out there, including Salazar, that are chomping at the bit in order to stake new ground that they've come across in the months since the mining cadastre was closed. So that would be a significant positive for mining in Ecuador. And then finally, a point that I think needs to be emphasized is that particularly in Ecuador, locals and indigenous populations hold a lot of sway, have a lot of power. And so for any given project, I think it's very important to analyze the social situation there and get a sense of whether the locals and the indigenous populations are on side. And if not, or you're unsure, whether management has the chops and has what it takes in order to ensure that's the case. Because even a phenomenal project can be stopped dead in its tracks if the local community's against it. And so, yeah, all that said, I do think there's significant opportunity in Ecuador, kind of even taking into account these underlying risks. Ultimately, the federal government understands that it needs mining FDI in order to drive the economy, and then also to meet commitments that they've made to the IMF in terms of economic growth and debt reduction. And so I, again, think it's an exciting place to be, but you have to be cognizant of the risks and look at each opportunity on a case-by-case basis.
Thanks for sharing your insights on that, Matt. For my last question, I'd like to get your thoughts on what you look for a developer when they're in that dead spot of the Lassonde curve. And what I mean by the dead spot, of course, but it's that place after the discovery has been made, it's been defined, the company goes into permitting, doing environmental and baseline studies. The risks are there with the environmental issues. Will they get their permit? Where is the CapEx going to come from? And it's kind of boring. The market doesn't get as excited during this time period. And over the last several years, I've met with a lot of CEOs that lead these type of companies, and I always ask them, what's the big thing you're looking for this year? And a number of them have just flat out told me, I need a higher copper price. I need a higher gold price. That's my strategy for the year, essentially. Others have told me, I thought I would have been bought out 2, 3, 4 years ago, but he's still leading the company. I met with someone at Beaver Creek this last year, and I almost felt sorry for him. He just seems so frustrated that he hasn't been bought out yet. So, Matt, when you're sitting down with one of these developers in that dead spot of the Lassonde curve before they see that re-rating as they come into production, what are you looking for in a possible investment here?
I think that's a very good question, Bill. We are willing to invest in this dead spot as you describe it, but it has to be under the right conditions. The first is that obviously the right people have to be involved. And when I say the right people in this case, it's preferably those that have already sold a development stage asset before. And so they have that street cred and they have that ability to go out there and market it and get a quality deal done. And or they've taken a development stage asset into production. That's probably even a better opportunity because that provides more leverage if a potential acquirer comes in. So the people have to be right. Secondly, the economics have to be compelling at the spot metal price or lower. That's just the way I invest. There are investors out there that are optionality investors. They like to bet on directions of metal prices. If you're good at that, that can be a very profitable strategy, but that's just not the way we go about it. So if I'm investing in a copper project that's kind of in this dead spot in the Lassonde curve, I want the project to make a lot of sense at 260, 270 copper, right? And when I say a lot of sense, I mean an after-tax NPV using a reasonable discount rate of maybe 8 to 10%. That is well above the initial CapEx, an after-tax IRR that is hopefully north of 25%, and a payback that ideally is 3 years or less. So those are pretty high bars in terms of economic numbers. And I think if you're willing to stick with the company through this boring and stage, it has to be worth it. You can't just be praying for higher metal prices. Another thing I look for, the company must have enough cash in the bank in order to get through their next milestone. Whether that next milestone is a feasibility study or a pre-feasibility study, or whether it's an important permit, whether that's an environmental permit or the final mining permit, you want them to be cashed up. If you don't think that they have cash to reach that next major milestone, even if you like the opportunity, it makes much more sense to just sit on your hands and wait for the inevitable private placement and then get a discount to market and or warrants. So the company absolutely has to be cashed up. And then, of course, better still is if the company has enough cash in the bank to make it all the way through construction financing before they have to dilute again. That's a strong position of strength where the company says, well, we've got a feasibility study coming out here in 6 months and a mining permit 6 months after that. We have 2.5 years of cash. So we're not going to raise again until the actual construction financing package comes. That's a real position of strength. That's something that would maybe get me over the finish line for something in the dead zone. And then finally, I would say I do want to see a large disconnect between the company's valuation and where I think it should be valued on a risk-adjusted NPV basis. So generally, I think pre-fees, PFS stage projects should be valued at around 20% of the after-tax NPV, and feasibility stage projects should be valued at around 30% of the after-tax NPV. In exceptional cases, these multiples can be much higher, but it has to be phenomenal economics in order to deviate from there. But I want to see a company valued at a substantial discount to where I think it should be based off of its NPV and the project stage. Otherwise, if I don't see that value, even if I think the project's going to be built, if I think it's fairly valued, I'd rather pass and look at other opportunities where I think I can get in, cheap.
You've been listening to managing partner Matt Geiger of the MJG Capital Fund. You can follow Matt on Twitter at Geiger Counting, at Geiger Counting. Website again is mjgcapital.com. Go over there, sign up for the newsletter. Matt sends out his newsletter to his email list. So this newsletter that I've been asking him questions about, you can get emailed to your inbox if you go there and sign up for his list. Matt, I really appreciate you coming on the show again and sharing with us your insights. Thank you for joining me today.
Yep, thanks for having me, Bill. Chat soon.